For the past few weeks, there's been so much chatter, so much volatility around the company's energy division, a lot of uncertainty. Well, that uncertainty is now over. In this explainer, we're going to break down exactly how that risk just vanished and why the whole investment case for this business has been fundamentally upgraded. So let's just rewind the clock a little bit. It wasn't that long ago, December 23rd, and the market was really pricing in a worst-case scenario. You can see it in this report. The consensus was that a critical tax subsidy was about to expire with basically zero chance of a last-minute rescue. The panic around the 2026 outlook, you could really feel it. But just like that, the panic is over. In what was a pretty stunning reversal, the entire narrative has completely shifted. So let's walk through how the single biggest risk was neutralized and why Wall Street now sees the energy division as a core pillar of the company, not just some speculative bet on the future. Okay, our first key pillar here is all about the regulatory side. This is really where the story begins. It explains how the market went from bracing for this hard cliff to, well, witnessing a pretty elegant soft landing.
To really get the solution, you first have to understand the problem. The legislation, which was known as the One Big Beautiful Bill Act, or OBBA, created what everyone on the street was calling the tax cliff. It meant a 30% investment tax credit, which is a huge incentive, was set to just disappear at midnight on New Year's Eve. The fear was a total collapse in demand for 2026.
And then this. This is the elegant solution that honestly came out of nowhere. On January 9th, the IRS issued what's called a safe harbor ruling. And what this notice did was clarify that any project that had simply started by the deadline could lock in that 30% credit for another 4 years. This changed the entire game, literally overnight. And this slide just illustrates the impact perfectly. The market went from expecting this severe demand air pocket and, tons of project cancellations to a smooth, totally manageable transition. All of a sudden, the company's entire project backlog became sticky and reliable. The worst-case scenario was just completely taken off the table. So with that huge regulatory risk neutralized, the market had a new question. How do you quantify this newfound stability? And that brings us to our second pillar, the establishment of a hard valuation floor for the business. The question on every single analyst's desk was this. Now that it's de-risked, what is this high-growth energy business actually worth on its own? And here's the answer that got everyone's attention. A major new research note from Goldman Sachs came out and pegged the value of the energy division standing alone at $210 billion. I mean, this chart really puts that re-rating into perspective. It's a massive step up from their previous valuation of $145 billion. And this wasn't just speculation. It was a direct response to two key things: the operational proof of a record 14.2 gigawatt hours deployed in Q4, and of course, that regulatory soft landing we just talked about. This quote from the Goldman note itself is incredibly telling. The language here has fundamentally changed. Energy is no longer a call option, which is basically a speculative bet on the future. It's now being called a core asset and a hard floor for the entire company's valuation. That's a huge shift in perception. Okay, so a financial re-rating is great, but it has to be validated by real-world operational execution, right? The theory is nice, but the market needs to see proof, and that proof is coming directly from the Shanghai Megafactory. Just look at this timeline for a second. It's really remarkable. Going from the start of production to full-on mass production in under 12 months, that is incredible speed. This ramp-up is the engine that's allowing the company to meet this surging global demand. And right here is the strategy in action. We're calling it the Shanghai Bridge. While the U.S. market finds its footing and stabilizes, the Shanghai factory is already busy servicing massive new orders from all over the globe. We're talking a 600 megawatt-hour project in Japan, a 912 megawatt-hour order in Chile. This just proves the global demand pipeline is incredibly robust, and Shanghai is the key to it all. So let's put these three pillars together, because when you combine that regulatory clarity, a brand new valuation floor, and proven operational execution, the entire investment thesis just undergoes a fundamental shift. So to quickly summarize the journey here, first, the IRS provided a crucial regulatory safety net, which de-risked the whole outlook. Second, Wall Street responded by establishing a massive, credible valuation floor. And third, the company is out there proving it can execute on a global scale to justify that value. And this really is the key question now. With the business stabilized and the thesis upgraded, what's the next major catalyst for growth? Where do we go from here? Well, that catalyst may already be on the horizon. There are some very credible market rumors about a next-generation Megapack XL that's in development. A targeted 25% jump in energy density would have massive implications for project economics and, importantly, for gross margins. This is for sure the next key development to watch. So the final takeaway from all this analysis is crystal clear. What was once seen as a speculative, kind of volatile side business has now matured. The energy division is a core, bankable asset, and it's absolutely fundamental to the company's overall valuation. The thesis has permanently shifted.